This is Super Investors and the Art of Worldly Wisdom. I'm Jesse Felder.
Object to the test!
This episode is brought to you by the Felder Report, my independent research newsletter. I have a free report that goes out Saturday mornings, and it's essentially just 4 or 5 things that I found during the course of my reading and research during the week that I think are special, that are important, that are must-read or must-see charts, anything like that. If you're interested in receiving something like this, like I said, it's free. Just go to thefelderreport.com, sign up right there on the homepage, and you'll be good to go. My guest for this episode is Jonathan Tepper. And Jonathan is just a brilliant guy. He's kind of been an acquaintance of mine for a long time, but I've never really had the chance to kind of pick his brain in the way that I do in this episode. And it was really inspired by his new book that has come out, which is, I think, really focused on the single most important question investors should be asking themselves today. We get into this topic and his book, The Myth of Capitalism. We also talk about his experiences, his formative years growing up, which were absolutely unique. He grew up in Spain. His parents ran a rehab clinic. We talk about his career in finance, what inspired him to get into history and economics, how he got his job at SAC Capital, one of the most successful hedge funds on the planet, and much, much more. So I really hope you enjoy my conversation with Jonathan Tepper.
Ever wonder why fund managers can't beat the S&P 500? Because they're sheep, and sheep get slaughtered.
Jonathan Tepper, welcome to the podcast.
Thank you so much for having me.
You know, I was really excited to do this because The Myth of Capitalism, your new book, is something. It's a topic that I've been following for a long time, and I'm eager to really get into. I mean, you've done obviously a ton of research for the book. Really eager to get into that. But before we do, I just was reading through your bio and stuff, and I followed you on Twitter for a long time and appreciate your research and all that. But it's fun for me to do these because I really get to know people as more of a person, not just their kind of online profile. And I'm reading through your bio, and I think I remember reading something about this in the past. But you write in your bio, as a child, almost all my friends were heroin addicts and ex-convicts. Most were HIV positive and died of AIDS. So I just have to ask you, where the hell did you grow up?
So my parents were Christian missionaries. My mother died about 5 years ago, but my father still works. And they started a drug rehab center in Spain in the 1980s. So my family arrived in 1983 in a neighborhood of Madrid called San Blas. And at that time, it had the highest rate of drug use and juvenile crime in Europe. And so my parents started helping people in the neighborhood. And at first, we're sending them to other rehab centers outside of Madrid. And then they realized that they needed to do something themselves in Madrid. And so they started a center with one heroin addict, Raul, who was like our older brother to there are 3 brothers, so 4 of us. And Raul then brought a lot of his friends in. And so the center just kept on growing and growing. And it really was a unique time and place. In the United States, at the time in the 80s, AIDS was primarily a gay disease, and in Africa, it was primarily a heterosexual disease. In Spain in the 1980s, AIDS was almost exclusively a heroin addict disease. So people transmitted it via needles. And almost all of my friends were heroin addicts that I met growing up in the neighborhood and then who went to the drug rehab. And what would often happen is they'd share needles when they were shooting up, or they would end up in prison and there would be very few needles to go around. And you'd have like one needle, which, 200 inmates would use. And that was how HIV virus spread. And so the cocktail of drugs that prevented, people from dying or, helped stop the sort of terrible consequences of HIV really became widespread in the Spanish medical system in sort of 94, 95, 96 period. And so most of my friends were dying of AIDS essentially in the 80s and early 90s. And then, once the cocktail became available, then, a lot of my friends are still HIV positive, but now have managed to live quite a long time with that. But that was really when I was a kid. was just going to sort of funeral after funeral. And my most vivid memories are going to the hospitals with my mom and dad to Ramon y Cajal, which is the big hospital in the north of Madrid, the infectious diseases ward up on the 8th floor.
Wow. I mean, I don't even know where, to begin with that. That's, I mean, obviously must have had a profound impact on you, as a person and especially through your kind of development, years. How has that affected you, or how did that affect your path afterwards?
So it's what was very interesting and strange is that I was aware of death, and it meant quite a lot to me. But my youngest brother Timothy, died in a car accident when I was 15, and then the process of grief is extraordinary. And my father and mother would read to us at the dinner table every night. That was part of our family tradition. And I remember they were reading C.S. Lewis's Grief Observed, and particularly after Timothy died, it became, I felt it even more acutely, losing friends. And I think it's strange. I've read about people who've lost loved one, close family members when they were in their teenage years, and I think those are particularly formative. And certainly this was all happening when I was a teenager. And so I think it made me extraordinarily focused. It made me feel that time was limited and I had to do something with it. And so it probably made me a little antisocial in the sense that I felt that other people wouldn't necessarily be able to relate to me or the particular experiences that I was having, because it was a rather odd childhood. And so it just made me very much, what people would call a nerd, where I just like study nonstop and, then work in the drug rehab with my parents. And my brother sent me his college textbooks. And so I ended up like taking 10 advanced placement tests and things like that. So it just made me extraordinarily focused and not necessarily the most well-adjusted kid socially, but that really was my teenage years.
Yeah, it makes you. I obviously can only imagine, but that it makes you more focused. That hey, these people aren't fortunate enough to have what I have now, which is time here to do things to expand my horizons and to make, a positive impact, which you have probably also obviously learned from your parents too. You said that kind of forced you into more of kind of a nerd type of thing. You actually were a Rhodes Scholar and studied modern history at Oxford. How does, what was it that inspired you to study history and be focused? Was that just a passion from a young age, or was there something else behind that?
Sure. So in undergrad, I studied economics and history. So I graduated with honors in economics and highest honors in history. And so I'd always been pursuing both sort of simultaneously in terms of my interests. And I was particularly interested in the intersection, which is economic history. And I remember it was my senior year at Chapel Hill when I was doing my economics thesis and my history thesis. So I was writing two at the same time. And I realized that like the further along you get in economics, the more mathematical and I would not even statistical, but the more mathematical it gets. And I realized that a lot of these models were based on assumptions, and in many cases, these assumptions I didn't think were true or accurate. And so I thought that economics seemed very theoretical and somewhat impractical. And I thought if I have to go to Oxford to study on the roads, I might as well do something that I think is a bit more grounded in reality, or at least it's empirical. And obviously, you can't test in history like you do in science, but at least like it did happen. And so I thought that might be an interesting sort of starting point to continue on the historical side and see, rather than made up models, to actually just see what happened. And so that's really sort of why I decided not to go further in economics. And I realized that I can still read economic books. I can still do research. And in fact, almost all the work that I've done over the last 10 years with variant perception has been, I hope, contributing to interesting economic insights.
Yeah, the further the more research and things I do, and I guess the older I get, the more time I spend in the world of finance, the more I find, history just becomes more and more valuable. And it was not something that I studied deeply in college or anything. But are there any interesting historical parallels you see to today, or any books that you could recommend to people trying to understand the current environment?
Sure. So I think that there are some historical parallels today to the past. Clearly every time is different, and there's always new wrinkles on what's going on. At Variant Perception, one of the first books that we make analysts or interns read is Manias, Panics, and Crashes. I think that's an extremely relevant book. I think that one book that I recommend quite a lot is Bernholz's monetary inflation. The Bernholz book talks about essentially how funding deficits leads to high inflation. That's quite useful. So it's Inflation and Monetary Regimes is Bernholz's exact title. I find very useful. And then I think the book by Reinhardt and Rogoff is extraordinary. Certainly one of the, if you had to pick a top 4 or 5 books to read on the macro side, goes through very well. And what we've got right now going on is an enormous buildup in debt. And these things actually do take multiple years, even though traders have, a 30-minute attention span. A lot of the dynamics that we've currently got in terms of a debt buildup are going to be playing out over the next couple of years. And you can look at the U.S. deficit right now, which on a cyclically adjusted basis is near extremes. And so when we go into the next downturn, it'll get even worse. And so I think that a lot of these lessons from the past are going to come back and be useful. And so the debt buildups that Rogoff talks about, I think, will certainly be more and more relevant. And then what Bernholz talks about, I think, to the extent that these very, very large deficits get monetized, we will end up with higher yields and higher inflation, or at a minimum, we'll end up with low yields that are suppressed and higher inflation, which is how we got rid of the very large debt burden after World War II.
It's fascinating to me that, you're focused at, Variant Perception on inflation. And actually, let's before we get to that, let's take a step back and I want to ask you about just Variant Perception and what actually inspired you to start it. What is it? What is your mission with that business?
Sure. So Variant, interestingly, was almost started by accident in the sense that I was working as a prop trader from 2005 to 2007, trading rates and currencies. Before that, I had been an equity analyst at SAC Capital. So I'd done equities and rates and currencies. And I was really writing weeklies to try to clarify my own thoughts to find good trades. And it was sort of through that process that I found that writing helped me think more clearly about trades and in terms of documenting evidence for what was going on. I was very worried about the subprime crisis in 2006, early 2007, and about the European periphery, the Spanish and the Irish banks. And so I kept on. I left Bank of America. I thought it was very big and bureaucratic, and they wouldn't let us put on a lot of the trades that we were trying to recommend. So I then started a user-generated news website with a friend, which was an extraordinary amount of fun. And then we sold that to Corbis, which Bill Gates owned. But simultaneously, I kept on writing these weeklies and monthlies, and I was sending them to friends that I had traded with, my colleagues who co-founded Variant, and we were sending these around to a group of people, and then they were sending them around further. And I thought, this is really stupid. We're basically setting up a charity for rich hedge funds to get trading ideas. And it was sort of through that we thought, we might as well incorporate ourselves and turn ourselves into something like BCA or ISI. And, worst case scenario, we've got a well-functioning, profitable research business. And best case scenario, eventually we take all these tools and start an asset management business on the back of it, sort of Variant Perception asset management. And so we realized that there was no real downside to developing a lot of these tools further. And we really built it for ourselves, which is I thought that one of the key problems that you have in research on the macro side is the focus and fixation on lagging economic indicators. So if you think about the unemployment rate or inflation, they tell you a little bit about the past. So typically, if you think of the real world, a factory boss doesn't raise wages for workers, just because they have a good month or two of sales. They wait until the end of the year. Then, if things are going very well and there's some price increases, and they give workers a raise, and then that happens next year. So it's very lagging. It tells you about where the economy was basically about a year ago or a little more. And likewise with jobs, if you run a real business, you don't start firing your workers just because you have a good month or two of sales. So the two things that the Fed targets and most of Wall Street looks at really are backward looking. And almost all recessions tend to happen, immediately following a decent GDP prints. So GDP itself is not forward looking. The things that are forward-looking are things like building permits and the yield curve and other inputs that are not particularly sexy and don't make great headlines, but they actually do tell you quite a lot about the future. And if you're a trader, you make money based on where things are going, not where they've been. And so Variant started out with written essentially a business plan in terms of all the tools that we wanted to build for ourselves that we would need to trade. And sure enough, for the next couple of years, managed to build them all. So we have leading economic indicators for G20 and all major emerging markets. But even more importantly, what traders make money on or not is the changes in asset prices. They don't make money directly, whether retail sales or industrial production are good or bad. So liquidity indicators are key. And the issue is there more or less real money or excess liquidity driving asset prices? So Variant has global liquidity indicators of a variety of sorts that do a very good job of leading, and then those provide insights into whether, for example, China is turning up or down, whether the U.S. is going to slow down or not. And then we also have about a dozen recession models, all of which have different inputs and methodologies, which then go into a sort of master model. And then, because each recession is different and no two are necessarily alike, where the 06, 07 was really, the beginning there was housing related. The 89, 90 was corporate related. The 2001 was sort of CapEx and technology. So each one's different. And so you have to basically be able to have multiple inputs. You can't just have one model with a fixed set of inputs, and exclusively rely on that and overtrain your model on the last recession. So that's really what sort of Variant is, what we do. And the hedge funds and family offices are our main clients. And we write about across asset classes, so equities, fixed income, currencies, and commodities. And some of it's very top down, like global liquidity, but a lot of it also is very bottom up in the sense that we built proprietary scores for bankruptcy prediction, proprietary scores for quality, and stocks tend to outperform when they have a high quality score, and things like that.
Yes, I'm glad you mentioned, liquidity. I think so many people are focused on earnings. It just reminds me of, the Druckenmiller quote from that speech he gave at Lost Tree a few years ago, where he says, earnings don't move markets. It's liquidity that moves markets. Pay attention to, central banks, what's going on, and because that matters far more, to what's going to happen in the future than earnings. Earnings are, what happened last quarter. They're backwards looking. I want to take another step back. You mentioned SAC Capital. I think, a lot of listeners, one of the most common questions I get from people is, I want to get into finance. I want to go work for one of these funds. Was it Steve Cohen that was the reason? Were you a fan of his? Is that why you wanted to go work for him? How did you get the job there?
Sure. So I didn't know an enormous amount about Steve Cohen, but I had this group of friends in London, and we've gotten together for Thai dinners every Monday night for the last 20 years. And, obviously, people travel and can't go, but it's just a fantastic group of friends. And one of the guys who was there was working in London and then went over to SAC. And at the time I had just left Oxford and was bored working for a big bank. It was Lehman Brothers at the time. And I just thought, I need to learn. I need to, get trained. And I don't mind working for free as long as I can learn. And so I told him, I said, look, I'd be happy to go over and be your analyst, and I'll do it for free. And so I went and interviewed, and they said, look, you don't have to do it for free. We'll pay you. And I started at the bottom, and basically for the next 2 years, I built, tons of financial models, did loads and loads of channel checks, and, basically it was supporting the senior analysts, in a lot of the research. And at the time, the internet bubble had burst. And so people were still calling, the sort of industrials and cyclicals and retail, essentially the old economy stocks. And so I was working in the Cohen account. I worked for Gabe Marshank and Andy Cohen. I learned an enormous amount, and basically that was sort of the pool of capital that Steve was running. They were working for him, and then I was like working below. So I probably had maybe 3 or 4 conversations in my life with Steve Cohen. Brilliant, fascinating guy, but I didn't have like loads of. I saw him every day, in the trading floor, but I didn't have a lot of contact with him, given that I was a junior analyst at the time.
Yeah, I love that you say that. I mean, I think that's what I tell a lot of people, which is this idea of being willing to go work for free in order to learn is, I mean, it's kind of the advice I give people when they ask me, hey, what should I, go do? I think it's so much more important to have a good idea of who you want to learn from, who you want to work with, because that matters more than just getting into the industry or something. So the idea of, hey, pick out who's your favorite investor, whatever, approach them, say, I will work for free, I'll do whatever to just be able to learn from you is a great mindset to have. Was there one big takeaway from your experience there at SAC that from your time there?
Well, so there were quite a lot of lessons, but I think if I had to come away with something, it was the fact that I worked on a variety of different industries and was building different models. I realized that whatever industry it is, there like you can build complicated models, and I did, but generally there's a couple few limited key drivers for an industry, and once you can hone in on what those are, you find out they're the ones that drive the financial model, and so I think that helped me realize that when you're analyzing different industries or different companies, as long as you can figure out what that key thing is and then be able to track it well, you'll do a good job.
Yeah, so let's get back to the inflation talk, because you mentioned in a couple of those books that you recommended that that's one of your focuses right now. To me, that's really interesting because I've been talking with my friend Eric Cinnamon about this for a year, and his framework is more listening to 300 conference calls, small cap companies every quarter, and it's something that he's been seeing in these companies have been talking about this for about a year now. I also recently talked with Ben Hunt, and he's been noticing the inflation narrative. Through his framework, he's seeing it more come up in the media and become more a popular topic there. It's just interesting to me from those two separate disciplines. They're kind of seeing that. What is your I guess framework that is helping you see kind of rising inflationary tendencies or risks?
So I think that when you talk about inflation, you can distinguish between sort of headline inflation, and that the leads there are fairly short, and they're mainly driven by the change in oil and commodity prices, the change in the dollar. And then there's core inflation, where you generally get about sort of a 15-month to 2-year lead, and that essentially is driven much more by the overall slack in the economy. And there are quite a lot of leading indicators there that work very, very well. And interestingly, so headline inflation peaks generally like 6 to 9 months. Basically after sort of oil and commodities peak, and unsurprisingly, the highest inflation print was the month that Lehman Brothers was going bust, and the world was about to implode into a huge deflationary downturn. So it doesn't really tell you; it's not at all informative about the present state or even the future. Core inflation has a much longer lead, and there's unsurprisingly, for example, core inflation bottomed in the summer of 2010, and at that stage, the global economy was actually doing quite well and bouncing back, and the trend in inflation was up, but core inflation prints were low, and that's when at the end of the summer of 2010, you had the Jackson Hole Conference, where they kicked off essentially sort of QE2, and because it's so backward looking, you can actually forecast it pretty well, because you just need to know where you were 9 to 15 months earlier. The bigger question, which I think is the one that you're referring to, is the structural drivers of inflation. Whether that's going to be, we had essentially a structural inflation dynamic in the 1970s, and then there's been essentially a structural deflationary dynamic that was going on in the 80s, 90s, and afterwards. And some of those are driven by demographics in terms of people entering the prime working age. or exiting that in the workforce. It's also driven by trends in government finance. So what Bernholz writes about essentially is that while the Fed can expand its balance sheet, if velocity stays low and there isn't an incentive to sort of lend out the cash, the excess reserves, then it's not particularly inflationary. And the danger really is when velocity does pick up and yields do rise, then you have all this excess money sitting around. And Bernholz points out that basically, if central banks are engaging in QE, you're just swapping out basically cash for bills or notes, and it's not particularly inflationary. But when government creates deficits and issues more bonds, and the central banks buy them, that essentially is sort of new money creation, and because that goes directly into the economy as the government spends it. So all the periods of high inflation and hyperinflation globally have happened when you had very, very high government deficits that were financed by central banks. And what's interesting is that in the U.S., actually, there was fairly limited budget deficits. There was a high one in 2009 and early 2010, primarily just because of the contraction in the economy in 08-09. But in 2011, there was a government shutdown. The U.S. deficits have actually been quite modest, and discretionary spending has in fact been frozen. So the U.S. didn't have a lot of the dynamics at play that would lead to high inflation, which is huge deficits being financed by the central bank. Right now, we are running huge deficits, but the Fed is tightening and not doing QE. What will be very interesting is if in the next downturn globally, because central banks have essentially bloated their balance sheets and taken over the debt markets, if the next downturn, if you get high fiscal spending and high discretionary spending coupled with QE, I think that then becomes very inflationary. And I suspect that that's what we're going to see in the next downturn is the fiscal plus monetary, which is what leads to high inflation. But the leading indicators that VP has point to slightly higher inflation, which is typical as you see in a late cycle scenario where you have record low unemployment rates and high quit rates and we've had relatively high ISM. All these point to sort of higher core inflation.
Well, I absolutely appreciate that perspective, because I think so many people are still focused on, demographics equal deflation. And so they're kind of ignoring some of these other dynamics that are at work, like, the monetary authorities having to potentially take a backseat to, fiscal domination for the first time in a long time. I wanted to ask you about, in terms of that, inflationary dynamic from a demographic standpoint, because you hear this all the time. Demographics are destiny, and demographics, in the minds of these people saying this, is that demographics equal deflation. Is that when you were talking about demographics? Is that how you're referring to it?
Yes. So if you're looking at when people are, almost everyone's entering the workforce, and you had essentially the peak in the baby boom. In the late 70s, early 80s, that really was tied to much higher inflation. As people get old, obviously they spend less, and there's less aggregate demand. What's fascinating is I sent an email to Bernholz, who's very kind and replied. I should have figured out that he's been around for quite a while. I asked if he wanted to come to London and speak to some investors, and he said he was in his 80s and didn't travel very much, and he lives in Switzerland, where he's been an economics professor. But we were trading emails because I was asking about Japan, and Japan is the only country right now that does fit his criteria for high inflations and hyperinflation, which is extremely large budget deficits that are financed by the central bank. And so I said, have you found false positives in your research where countries fit your criteria but didn't have high inflation? And he said no. Which I thought was very interesting. And I said, well, how do you explain Japan right now? And he said it's very difficult. He said the only thing I can assume is that this is tied to the demographic situation, in the sense that we've never actually seen a country where everyone is getting old, and you might be able to pump more money in terms of monetary base, but it doesn't necessarily lead to higher inflation. So I think that because we haven't really seen societies age before, we haven't seen populations decline. We don't really have history to tell us what's going to happen. And, I think that is absolutely fascinating. Earlier we were talking about reading history to learn, that there isn't really anything that we can read about in this regard in terms of how the demographic dynamics, what does an aging population mean towards inflation? I suspect that it doesn't mean that you can't get inflation. I just think it's probably makes it harder.
Yeah, and I seem to recall, I can't recall right off the top of my head exactly the title of it or anything, but I think the IMF put out something a few months ago, maybe a year ago, that showed in most countries, demographics are tied to inflation in just the exact opposite dynamic that you would assume, that as populations age, actually inflation goes up. I don't know. It seems to me that there's this idea that people spend less in old age. Yes, by a lot of respects, yeah, they're not going to buy fancy cars. They're going to downscale the house, but they do have to spend on healthcare and these types of things. And so, especially here in the U.S., healthcare is so expensive relative to the rest of the world that it seems to me spending could actually go up in an aging society here. But that's probably a topic. Go ahead.
No, absolutely. There has been differing studies, and I've got both, or studies from both directions. Where the IMF did write that actually you would see, an increase in inflation and wages, given that you'd have to bid up for the labor of the fewer workers that were around. And this gets back to the problem in economics in terms of, you can have lots of models and change the assumptions, and you'll end up with different results. So I don't think that it's not an open and shut case in terms of what happens with inflation with an aging society. I've seen models and projections saying the opposite.
Well, yeah, and then you combine that dynamic of a shortage of workers from a demographic standpoint that pushes up wages. Combine that with another dynamic that we're seeing, which is the tendency towards nationalism and deglobalization. And I think it's pretty obvious globalization was one of the strongest disinflationary phenomenons we've seen in the past several decades. That deglobalization would have the exact opposite effect, which is shrinking the supply of labor in a certain respect. That you combine that with a demographic trend and shrinking the supply of labor, it could be both of those things working towards a higher structural inflationary dynamic.
Absolutely.
Yeah, let's get to the book. So obviously just talking about some of these topics that this myth of the myth of capitalism had to be something that you were paying attention to. What was it specifically that inspired you to dig deep enough into this to actually write a book about it?
There were two main factors, not directly related at first. One was I was having arguments, very friendly discussions over beers with friends in London when Piketty's book came out. And my friends were saying, well, capitalism itself has a fatal flaw, and this is extraordinary. They've now found it. It's low growth leads to high returns on capital. And I was arguing, saying, well, this makes no sense at all. If you have, very high profits, I'm going to want to go after those profits. I'll go in and I'll compete with you, and I'll, take away some of your profits. And so Jeremy Grantham said that profit margins are the most mean reverting series in finance. And if profit margins don't mean revert, then something's seriously wrong. And at the same time, I've been following on Twitter and blogs. People will often talk about whether profit margins will go down or not. What does this mean for investing? Clearly, historically, there's been a very high degree of mean reversion. And the most dangerous words in the English language, are "this time is different." And I started to think, well, is this time different? And will we see some mean reversion, or have we seen a structural change in the economy? At the same time, as I was mulling over these ideas, I mentioned that variant perception has leading indicators for inflation and growth. one of the leading indicators that we have is for U.S. wages, and it has inputs that are very intuitive and that make sense. So for example, if you want to forecast wages, one of the inputs you use is the quit rate. If people are leaving their jobs, it's telling you that they're going to jobs that are more highly paid. Generally, they don't tend to leave their job for a less highly paid one. And so you can take some of these inputs, plug them in, and it gives you a pretty good 15 to 21 month lead on U.S. wages. And for the last sort of 8 or 9 years, the indicator had been turning up, and we haven't really seen almost any increase in wages. And so I started thinking, like, well, maybe our indicator's broken, but it shouldn't be broken because the inputs make sense. And then I started realizing the more research I was doing is that these two factors are interrelated, which is that over the last 40 years, what we've seen is merger wave after merger wave. And if you think about it as like the NCAA Sweet 16, you start out with 16 and then you go down to 8 and then 4. And so what's happened in many industries is you've got fewer and fewer players. You've got fewer companies competing for workers. And at the same time, going back about 50 years, you've essentially had a decline in unionization in the United States. So companies have become more concentrated and there are fewer of them. And at the same time, workers have become dispersed and are not collectively represented or bargaining. And when you put those together, it clearly means that workers are going to be losing out in terms of wage dynamics. So the real question, I think, for investors is, are there a superior class of companies now that are in dominant positions, and are these profit margins sustainable? If the answer is yes, then they might be justified in having higher PE multiples, and it then means that this cyclical, mean reversion that's going on might be more muted. We're not going to get rid of cycles, certainly, but you might see a less mean reversion than we did in the past. And so that was really how I got into the subject. It was purely from like a research standpoint without an axe to grind, just trying to find answers.
No, that is. Yeah, that's fantastic, because to me, I think this is absolutely the most important question that investors should be asking themselves. Are profit margins sustainable? Because everybody looks at the price to earnings ratio and goes, oh, we're only 22 times earnings. That's not crazy, especially, based on the last 20 years average. I mean, back throughout, longer period of time, we're definitely on the high side. But I think 99% of people who talk about the price to earnings ratio don't realize that the earnings number is built on the highest profit margins in history. And so if you're using the price to earnings ratio to justify buying stocks, that means you're assuming profit margins are going to remain this high indefinitely into the future. So to me, there's that embedded assumption that people are making without even realizing it. So it's fascinating to me. So let's dig into this. You found that concentration has been really responsible for these rising profit margins. Is that kind of the thesis there?
Yes. So when I started digging into the changes in the U.S. economy, one of the best papers that I ran across was a paper by Gustavo Grullón. He's a professor at Rice University, and his last name is Grullon, Grullón. And the title of his paper is, are U.S. industries becoming more concentrated? And what he shows is that the industrial concentration has risen substantially over the last 20 years. And then he looks at the profitability, and he looks at whether buying these companies or not would have beaten the market. And what's very interesting is he shows a couple things. One, that the high return on that these companies have higher return on assets. That the return on assets does not come because they're more efficient. It comes because they have greater pricing power. And in the book, I discuss Buffett and the idea of pricing power. But what really happens is that these very large companies end up with a significant amount of market power. They have market power over the consumer in the sense that they can raise prices. They tend to have market power over the suppliers in the sense that they can demand lower input costs. And then more controversially, which people are starting to focus on now, is that they actually do have market power over workers in terms of wages. And so when you put all those three together, that's one of the things that explains why many companies actually are getting higher earnings and higher return on assets.
This really gets to what the myth is in the book's titles. The myth is that we actually live in a free market economy where there's a balance between, corporate power versus worker power, and that's just not the case today.
Yes, it's quite interesting. The idea of the myth comes from the fact that people think that they live in an unbridled capitalist system, and what we're living in has all the elements of capitalism. But as I point out, capitalism involves one, private property, which we do have, and two, it involves competition. To end up with clear pricing signals which induce the right amounts of supply and demand. And that, unfortunately, the competition side is being eroded in terms of having less and less competition. And I look at dozens of industries where the number of players have gone down, where the levels of concentration has gone up. And to describe the current markets as being competitive and capitalist in that sense is a myth. And that's really where the title comes from.
And so it's not necessarily like the old, monopolies, that we would think of. It's more of kind of a duopolies and oligopolies that are essentially cornering their sectors these days.
So there's a very interesting discussion there, and part of it is monopolies are widely perceived to be bad, and so most people tend to agree on that. What people then don't discuss is the next step, which is, are duopolies and oligopolies bad? Some people say, well, these companies are highly competitive. And if you have 4 companies in an industry, they're just going to fight it out. And, that's a pretty good situation. But what I discuss in the book is that if you look at like game theory and you look at tacit collusion and you look at price fixing, and I go into great detail on these, you can see that, in fact, highly concentrated industries end up playing repeated games with each other, in terms of game theory, where they have every incentive to collude and to cooperate. And so there are loads and loads of cases of price fixing, loads of cases where they communicate with each other. You can do that via conference calls where you tell your investors, how much you plan in terms of expanding your own capacity, so your competitors know that you're not going to overexpand, so they don't overexpand. And that means that an oligopoly situation, in fact, is not highly competitive, and that's exactly what we've seen. So when you get down below 6 players in an industry, there's quite a lot of research that shows that prices go up in almost all cases. So that explains why Americans pay a lot more than Europeans do when it comes to cell phones, to cable, and then the American healthcare system I spend quite a lot of time on, because Americans think that the Europeans have this horrible monopoly of a state-run system like the British NHS or the Spanish national system. And they think Americans have this sort of rugged, free capitalist market in healthcare, when in fact, the U.S. has the worst of both worlds, where you have extensive regulation and government involvement, and you have private companies essentially that are able to use that regulation to keep out competitors and then extract enormously high rents.
Yeah, I want to talk more about that specifically, the regulation side of things. But I also want to come back to the game theory side of it too, because I think it's actually pretty simple for people to understand. Through like a Nash equilibrium or something. When I just think of the movie, A Beautiful Mind, when they're trying to, and I think you actually mentioned this in the book.
I do.
Yeah, why don't you explain that?
Absolutely. So the key book that readers should read if they are curious, and I mentioned in the book, is a book by Robert Axelrod called On Cooperation. And basically, what's very interesting is in game theory, the canonical example is the prisoner's dilemma. And so let's say you and I were both deciding to rob a store, right? And the police apprehend us, and then they interview you separately in one cell and me separately in another. And the ideal scenario from our standpoint is you don't rat on me and I don't rat on you, right? And ideally, we both get off. In the worst scenario is obviously where you rat on me and I rat on you, and then we're both going to jail and neither gets the benefit of ratting. And then there's also the uncertainty, which is, will I rat on you while you don't rat on me, right? Or will the other way work, will it be reversed? And so what happens is if you play a game once, you might have a very strong incentive to rat on your friend and get a better deal for yourself. So if you think about markets, if you're just playing one game, you might think, you know what, like we're going to have a little price war here and compete with the other company and try to steal some market share. And that's essentially sort of defecting. But what you find is if you play the prisoner's dilemma game over and over again, and Robert Axelrod in this book, he set up essentially a prisoner's dilemma game that economists, computer scientists, and mathematicians could submit programs, and then they would all play with each other, over hundreds of times. And every strategy would play with every other strategy. And the idea was to find out what's the dominant strategy. Is it to basically always defect, or to defect only when the other guy's cooperating and you've lulled them into a false sense of security? The answer really, the dominant strategy is to essentially tit for tat. It's to always cooperate, meaning if the other person's not cooperating, you don't cooperate. If the other person cooperates, you cooperate. So basically you're just mirroring. And what he found out is that cooperation emerges as the dominant strategy. And you see this in business, where the dominant strategy for oligopolies and duopolies is essentially cooperation. It's collusion, or whether it's tacit or explicit, but it's like you don't want to engage in price wars. And the minimax theory was promoted by John von Neumann. And, the example he gave essentially was, if a mother has two children and she gives them a piece of cake and gets one to cut it and the other to pick the piece, you're going to end up with the most even cake cutting you've ever seen. And the reason why that's the case is that what people are trying to do is to minimize their maximum loss. And so price wars and gaining market share sounds wonderful, except that what competitors really want to do in the long term is minimize their maximum loss. And so therefore, they don't really want to have extensive competition in the industry. And you end up with companies essentially cooperating. And I go through dozens and dozens of examples and studies indicating this. And, it doesn't matter what industry you're looking at. Like, recently there was a case of tuna in the U.S., and it was Walmart and other grocers that brought the case that there was collusion in the tuna market. But, you've seen collusion in the Canadian bread market. It doesn't matter where you look. You find that companies generally try not to compete if they can avoid it.
Yeah, it's funny because over the summer I read a book called Thinking Strategically. It's kind of just a basic introduction to game theory. And, the subtitle is The Competitive Edge in Business, Politics, and Everyday Life. And most of the examples they use are companies using game theory to figure out how they can best protect their margins. And it was interesting to me because I just wanted to understand game theory better, but all the examples they use are in business. So it's pretty, and this book came out in 93. It's one of the most popular books, related to game theory. So it's pretty obvious that, corporate executives have been reading this stuff and paying closer attention to it. So they're not, making these mistakes that, that they've made in the past. But, I also want to come back to this topic too of, regulatory capture, because that's also another important dynamic that's going on.
Absolutely. So regulatory capture is the idea that very large companies that are regulated by an entity. So in the case, for example, of Comcast and FCC, you have other companies that might want to merge, and like Google, for example, might want to capture the FTC, which enforces antitrust. The idea is that these entities are initially set up to rein in large companies and oligarchs. And you've had, for example, like the Interstate Commerce Commission, the ICC regulating railroads, which was set up in the late 19th century. And essentially what happens is that the ICC became very friendly with the railroads themselves. So while initially the ICC was meant to go after the railroads and to look after the little guy, over time, the regulator and regulated companies get very close, they get very cozy, and then you essentially end up with a revolving door where when people leave the FCC, FTC, they end up going to work for Washington law firms that then represent the companies that were regulated. And then every 4 to 8 years, you end up with a change in administration, and then people go back. So it's a revolving door in both directions. And you often have, people who've been in and out of government for the last 30 or 40 years, basically regulating companies that they previously worked for or represented. Now, in some cases, they recuse themselves. In other cases, they don't. And what that means is that these regulators aren't looking out for the little guy necessarily. What they're doing is looking out for former clients, and their very mindset is such that they tend to fully sort of have taken on board the doctrines in the case of antitrust of consumer welfare, which is all mergers are good because all mergers lead to an enhancement in efficiency and lower prices, and therefore, don't rock the boat. And that's really sort of what you see. And I go through quite a lot of examples in the book, and I'm probably going to do a follow-up piece, which will appear in the American Conservative on regulatory capture, but it's absolutely jaw-dropping when you consider the revolving door where people work for Google, then go and work in the White House, and then leave the White House, go work for Google. And that's just one example. There are many other companies, companies that approve mergers end up going to work for the companies whose merger they approved, or you have patent examiners who end up working for the companies whose patents they've approved. And clearly, this is the corruption of markets and the corruption of capitalism when you have the government intervening actively on the side of the big against the small.
Yeah, and there's another factor also that I think you touch on also in the book, which is that there's an interest rate factor also too, that low interest rates also allow companies to consolidate a little easier than they would during high interest rate periods. Would you care to explain that?
Absolutely. So that was one of the very unexpected things I found in the book. I did not at all want to really be addressing monetary policy or fiscal policy. I think I'd done that in the past with Endgame and Code Red. And so that really wasn't at all what I was interested in. And as I was looking through the research on collusion and cooperation, I was trying to find research as to sort of, how and why does this happen? And it's fascinating that one of the key studies that I cite in the book showed that the real level of interest is one of the key determiners in the rise and fall of collusion and cartels. And so I think the reason that they offer is essentially that there's a huge cost in being patient and waiting to see what your competitor is going to do, right? And that involves uncertainty. And so when real rates are very high, firms tend to be impatient and don't really want to sit around and wait and watch to see whether there's going to be cooperation or not. But when real rates are very, very low and negative, then firms can afford to be fairly patient because the opportunity cost is quite low. And so the research paper pointed out that essentially it was monotonic or almost perfect in terms of the correlation between the rise and fall of cartels and real rates. So to the extent that we've been in a negative real rate environment, very, very low rates, that certainly has encouraged firms to be patient and cooperate.
So there's obviously several dynamics all kind of conspiring to boost profit margins. It reminds me of, back in 99, actually when Buffett wrote in Fortune magazine, kind of this is warning that the dot-com mania was out of control. He addressed profit margins back then, writing that, in my opinion, have to be wildly optimistic to believe corporate profits as a percent of GDP can for any sustained period hold much above 6%. One thing keeping the percentage down will be competition, which is alive and well. Obviously, we haven't seen that since 1999. In addition, there's a public policy point. If corporate investors in aggregate are going to eat an ever-growing portion of the American economic pie, some other group will have to settle for a smaller portion. That would justifiably raise political problems. And in my view, a major reslicing of the pie just isn't going to happen. This is actually the reslicing that we've seen. Profit margins have gone higher and been sustained higher since that time. How do you see this kind of working itself out? I mean, do you see them as sustainable now, or do you see, this? I guess what it comes back to in this quote that I'm referring to is, will workers continue to settle for a smaller portion? Because that's where I really think it comes back to.
So I think that we're already seeing a rise of populist movements in the United States and elsewhere. If you look at the election of Trump, that campaign, Trump, throughout the campaign, was saying that he thought that markets were rigged. Bernie Sanders was saying the same thing. At about the same time, you had Jeremy Corbyn in the UK, who kept on saying that the economy was rigged. Clearly, the way to get elected as outsiders, where Trump wasn't truly a Republican, he never really participated in the Republican Party. Sanders was a socialist, essentially, who joined the Democratic Party, and Corbyn was like in the far left of the Labour Party in the UK. Clearly, people want an outsider. They want someone who is telling them that the system is rigged. And I think that the rise in populism that we're seeing in third-party, politics is happening in industrialized countries where workers are losing out. And so, I think that it is contributing to change. I think that it'll probably grow larger. Well-informed sources have told me that this is going to, the antitrust, essentially monopolies, and the industrial concentration is going to be one of the key themes for the election in 2020, in terms of particularly on the Democratic side. And my own view is that it's necessary, and I don't think it's a left or right issue. And I think that if people generally do care about capitalism and free markets, the best thing to do is to have capitalists themselves reform it, if they don't want to have people who don't believe in markets change them and reform them. So Edmund Burke, in his thoughts on the revolution in France, pointed out that if you don't reform, conservation is not possible. So there's nothing more conservative than reform. And the French monarchy did not reform itself at all, and therefore ended up with a revolution in France, which ended the monarchy itself. And so I think that one of the key ideas of conservatism essentially is the need for gradual and necessary reform. And I hope that that's achieved by people who do care about capitalism and free markets.
It seems to me that it's inevitable, just we go through cycles where, capital dominates and then labor dominates, and it, just kind of goes back and forth. And we're just kind of, I think we're near one of those turning points. And reading your book was really kind of, enlightening for me to see a lot of the dynamics that I kind of sensed were out there, but didn't really have a great handle on them. It's very well done. So if you see an environment, that where we have potentially reverting profit margins over a period of time, plus structurally rising inflationary risks, how do you see this world as an investor? What are some of the themes that you draw from that on the investing side?
Sure. So I do think that people tend to overpay for earnings with high multiples on peak margins. I don't think that the U.S. is about to head into recession. I think that global indicators have certainly been turning down, and many countries do have negative leading indicators. U.S. leading indicators have been rolling over, but are still positive. And I think it's much more likely a matter of when, not if, you end up with a downturn in the United States. And I'm very agnostic and will rely on the leading indicators that Variant Perception has. But for many stocks, obviously they're still pricing in a very long period of high profits with peak margins. And so I think that there are many equities that are overvalued. You could argue that the cyclical sell-off we've seen already has certainly put a dent in some of the cyclical names. But when things do turn down, equities are relatively overvalued. I think that bonds catch bid in a downturn. So clearly the long end in the U.S. Is attractive when a slowdown emerges. But getting back to the structural point, the tax reform that we've seen over the last year is on a structural basis is blowing a huge hole in terms of the budget deficit. And to the extent that these persist and are monetized, I think that we're looking at a higher trend in inflation, and yields, where people will have to, the supply will be such that people will demand higher yields in order to take down the supply in bonds that's coming from a large and growing budget deficit. So those are some of the key considerations. And obviously, I look at a lot of the indicators that we have in terms of telling us, when you should be preferring cyclicals versus defensives. And VP has been essentially sort of long defensive, short cyclicals most of the year due to some of the dangers that we were seeing in terms of high oil, high yields, and slowing global growth.
Got it. I want to. I've taken up a ton of your time already. I want to ask you something more, kind of on a personal note, but it still comes back to the investing side of things. I think I've said this on the podcast before. Will you in your bio mention that you're a fan of jazz? And I've been a fan of jazz for a long time. Not a huge fan, but there's a Miles Davis quote that I've mentioned on this podcast before. It's one of my favorites, and I think because it has direct parallel to investing. He said, music is the space between the notes. It's not the notes you play, it's the notes you don't play. And I think that has so relevant to investing. It's the trades you don't take, right? It's being able to not trade and avoid making mistakes when you feel like you're forced into trading when there's not a great opportunity out there. Is there something in jazz or some other, hobby or something where you see distinct parallels to investing or economics?
Well, it's quite interesting. I used to play the trumpet. I love jazz. Wynton Marsalis is one of my heroes, and he compared jazz musicians to Baroque musicians. In the Baroque period, you had the bass line that was laid down, that was the basso continuo, and then the players essentially would improvise over it and often compete to see who could do the most interesting improvisation. And jazz is very much the same, where you have essentially sort of the bass is laid down and then people improvise on top. And I think that markets are similar in many ways. History doesn't repeat itself, but it certainly rhymes. And what you really are doing is trying to figure out, sort of what the beat is and then improvise over it. And I think that, you have to master the basics and then be willing to essentially improvise and adapt. And so that's one reason why I love jazz, and I think it does apply. You have to master all the basics and be open-minded to change.
I love that. All right, what key are we in? What's the tempo? Okay, right. If you don't have the key right, you don't have the tempo right, you're not going to sound very good.
Exactly.
That's a great point. Well, we are out of time, but I highly recommend everybody go get Jonathan's new book, The Myth of Capitalism, at Amazon. Follow him on Twitter at jtepper2, and check out variantperception.com. His research service just provides a ton of value. Jonathan, thank you so much for taking the time to do this. That was fantastic.
My pleasure. Well, thank you so much for having me.
Looking good, Billy Ray!
Feeling good, Lewis! And that does it for another episode of Super Investors and the Art of Worldly Wisdom. As always, you can find notes and charts related to this episode at thefelderreport.com. Thank you so much for listening, and until next time, buy low, sell high.
Man looks in the abyss. There's nothing staring back at him. At that moment, man finds his character. And that is what keeps him out of the abyss.